many credit agencies, just continue cutting or threaten to cut the credit rating of commercial banks and also the country's bond rating.
Yeah.
Do you agree with them? Like, the acting of cutting the rating recently?
It's a really interesting question, and I think quite apart from just looking at the individual actions that they're taking, which are very interesting in themselves, I think there's also a bigger picture here, which is quite interesting, to do with the whole investment market, the whole economy, and even everything to do with human behaviour. When you play golf, if you take one shot more than you're supposed to take, they call that a bogey. And the reason for that is hundreds of years ago in Scotland, people used to imagine that they were playing against basically a made-up opponent, a bogeyman, and if they got one shot less than the bogeyman, they won the hole. So they had somebody to blame basically if they lost. And I think one of the questions about credit rating agencies is, do they just exist so that we've got somebody to blame when things go wrong? Do they actually really exist so that there's somebody there who can quantify things that really are measurable? Because that's how credit agencies really started out in life. At that stage, they were working for investors. So investors used to ask credit agencies to assess individual securities, and the agencies would come back with reports saying, yes, it appears the credit is good, it appears their business model is good, but they were paid by investors to do that work. The other thing that it seems maybe we're expecting these guys to go and measure things that just aren't quantifiable at all. We're asking them to give ratings on things that you can't measure. Now, it's really a whole interesting topic. I mean, Nassim Taleb is a famous author who's written a couple of books about the way that we all want to try and create order when actually things are completely random. So there's a book called Black Swan, there's a book called Fooled by Randomness, that are very well-known investment books, and they're about this whole concept of, are we trying to create order sometimes? Are we trying to arrange things into patterns when patterns maybe, don't even exist at all? And so I think, one difficulty for rating agencies is in 2011 we don't really know what they are. We don't really know what job we're expecting them to do. They're no longer just working for investors. If investors want to get information about a particular stock or a particular bond, they don't really base it on what a credit rating agency said, and they don't have that direct relationship anymore. The credit rating agency isn't really working for them. In 2008 we became very uncomfortable with the fact that credit rating agencies had been working for the companies whose securities they were rating, all these subprime securities that they've been rating. That suddenly made us very uncomfortable about conflict of interest. So we're not really sure, what credit rating agencies do and who they do it for. If I can use another sporting story, maybe. When we saw Tim Geithner, Secretary Geithner, famously go on TV and say, it was a terrible decision for S&P to cut the US rating the US rating from AAA to AA. We were reminded actually of there were a couple of female athletes in the 1930s, Stella Walsh and Helen Stevens. And in the 1936 Olympics in Berlin, Helen Stevens, who was an American athlete, beat Stella Walsh to the gold medal. Stella Walsh and all her fans were so upset, they accused Helen Stevens of being a man. They said this was a man dressing up as a woman to run in races, and Helen Stevens had to undergo a lot of medical testing, and they found out she really was a woman. She was maybe bigger and stronger, but she actually really was a woman. There was, these allegations were unfounded. About 50 or 60 years later, when Stella Walsh died, the woman who'd accused Helen Stevens of being a man, it turned out that actually Stella Walsh all this time really was a man, and so she'd actually been making these accusations against totally unfounded accusations against Helen Stevens. And we kind of felt a little bit like that when Secretary Geithner turned around and said that it was a bad decision by S&P, because actually the reason why the US rating was downgraded was because of what his predecessor, Hank Paulson, had been doing when he was Treasury Secretary, and what the Fed under Ben Bernanke had been doing. They'd been doing this totally irresponsible monetary policy that had created so many dollars in the system. There are so many liabilities that we still don't know how far they go. So, we think there was a little bit of hypocrisy there. We thought, in English we have this phrase about the pot calling the kettle black, and it means, to try and maybe get the attention off yourself, you blame someone else. So I think there's no doubt that rating agencies did a terrible job all the way up to 2008. We know that, but I think that we have to be careful now and look at who's criticizing them and why they're criticizing them as to whether that criticism is actually valid. And to be fair, if S&P did make a bad decision in downgrading US debt, then I think that the problem with the decision is that they should have done it sooner, and maybe it should have been an even starker downgrade than it was, because it's very unclear to us that the US deserves its current credit rating. There are a whole bunch of systemic risks in the US system that mean the US, to our mind, and certainly to the mind of, say, some of the Chinese credit rating agencies and some of the independent credit rating agencies like Egan-Jones, there's a lot more risk in US sovereign debt than a AA rating would even imply. So I think we have to look at why they're giving these ratings and really what is a fair basis of criticism or not. One thing that strikes us is that when we're creating portfolios, we don't really take into account what S&P might think about a particular security, or what Fitch's or Moody's might think about a particular security.
But it might affect the sentiment of the investing in particular country or something.
Absolutely, I think that's what happens. It's almost as President Roosevelt said, there's nothing to fear except fear itself. And I think what actually happens here is that nobody believes the S&P ratings or the Fitch's ratings or the Moody's ratings. No competent professional managers actually really pay too much heed to those. But what happens is when they get downgraded, they worry that other people are going to pay attention to those, and then it actually becomes a self-fulfilling prophecy that you better sell because everybody else is going to start selling, even though maybe you don't agree with what the S&P rating might be. There's another problem, I think, which is again why we need to understand what we're expecting of agencies, what we expect them to do. A lot of investments are mandated by reference to the quality of the assets that are inside the investment as dictated by credit rating agencies. Now, I guess in a sense that makes it easy to understand, if you're buying a AAA rated bond fund, all the securities in there are AAA rated.
Right.
But the problem is that there's an incentive, I suppose, for some investment managers to go and start using poorer quality assets, because if there are some AAA assets that the market prices at a certain level, it says, yes, they really are AAA. But there are other AAA assets that the market is saying, actually, we're not so sure about this. We think it might get downgraded. We don't really trust the credit. That would be available at a lower price or at a higher yield.
Right.
So in that case, there's actually a real incentive for some fund managers maybe to go and try and get a better yield, a better return by buying the worst possible quality debt that they can find within a stipulated rating category. And that's really what happened in Europe, that when the Eurozone was formed and we started to get a kind of common rating across the entire Eurozone, well, Greece and Germany kind of fitted into the same investment pot at that stage. And the markets knew that Greece and Germany weren't the same thing, even if they believed that Germany was going to backstop Greece. And so maybe there was a 100, 150 basis point spread initially on Greek debt over German debt, which narrowed because everybody wanted to buy the Greek stuff, because it was, on paper, it was exactly the same risk, but it was paying a much higher yield. And so there's actually a danger that these things create malinvestment by bunching things in together and by applying inappropriate ratings.
Could you say that the role of the credit agencies would be one of the causes of the problem that we are seeing right now?
I think the problem is that nobody really knows what the role should be, and therefore I think people still apply too much faith to these things. And I think that on one hand we have professional managers who just don't take these things particularly seriously and use their own research and their own ideas. On the other hand, we have parts of the market that still apply too much faith to the rating agencies. Now people are saying, maybe one way you get around that is you introduce regulation. So rating agencies are now covered by Dodd-Frank, and we have this situation where the S&P leak that France was going to be downgraded is being investigated by the ECB. So we have all these situations going on, but that kind of worries us a little bit as well, because these are meant to be independent bodies that are going to be giving opinions about, say, the US government. And if they're going to be regulated by a US government body, but they're going to be giving negative opinions about the US government, again, that's almost getting into the conflict of interest area as well. So it's very difficult to see what the role should be for credit rating agencies going forwards from now. I mean, I think what we would say is largely tend to ignore them, get proper professional analysis of any security. Don't just rely on the fact it's got a particular label on it. And if the agencies are still doing anything wrong today, it's probably that they're still being too optimistic about stocks and about securities, and for too long. Lehman Brothers was AAA rated virtually till the very end. Ireland, the Irish sovereign debt was AAA rated until 2009, which was 2 years after the crisis began. So, there's a real concern that if they are still doing anything wrong, maybe they're still being too lax.